they don't understand money, credit, or debt, right? There's good credit, there's bad credit, there's good debt, there's bad debt, and there's a way to handle money. And money is a tool, not the goal. And people don't seem to understand that. They're not taught this.
Hey everybody, it's Patrick Merrill. I am a realtor here on the beautiful Mississippi Gulf Coast. I work with Caldwell Banker. I'm licensed in Mississippi, Alabama, and Florida. I like to spend a lot of time in my vehicle and on the road, you could say. So I got Jeremy Brown. He is a loan officer that we enjoy working with a lot. We want to talk a little bit about shopping the different lenders, how you feel about that, and if somebody comes and calls and say, hey, I can get this at 5.25, and they're saying, can you beat it or things like that we can work with. Jeremy, I guess who are you with as far as your lending, the company name, and talk a little bit about yourself, if you don't mind?
Absolutely. Good morning. My name is Jeremy Brown. I'm with GMFS Mortgage. Our office locally is in Mobile. I'm licensed in Louisiana, Mississippi, and Alabama to do mortgages. And yeah, Patrick, thanks for having me on the show. There's a lot happening out there in the mortgage world. You wanted me to talk about the different interest rates and the advertising and the marketing that we see. And when you see an advertisement that says, hey, I get you 5.99%. Well, there's an APOR that goes with that, and there's more to it than just that 5.99. It's how did you get that 5.99? So to get a little technical on it, a little nerdy, the interest rates are based on the market, and as the market fluctuates, the interest rates fluctuate. As an interest rate is coming down, as you're getting lower than what the prime interest rate is, you're having to buy the difference in those points. So if someone is offering you a lower interest rate than what anybody else can offer you, then the question should be is how? Who's paying for those discount points? Are they being financed into the cost of that mortgage? Are they being paid for by the seller? Are they being paid for by the builder? There's a bunch of different ways it could be paid for. It's not always a bad thing, and it's not always going to be something that you're paying for, but you need to be aware of who is paying for it. And that is going to be on the settlement statement showing you who's paid for that. So as you're talking to these lenders, ask the question, you know, how are you getting me that rate? If everybody else is offering you 6.99 and they're offering you 5.99, where is that 1 point being paid for?
So it's gonna be in the paperwork. It's one way or the other. If let's just say I'm doing a regular FHA loan. Now
Mhm.
on that type of loan, say I got a first time buyer. What is usually the percentage down that buyer would need to consider when we start looking? So I know
On a,
usually 100 to 200,000. Isn't it like 3.5%
it
down
is.
or
It is.
okay?
It's 3.5% down payment. So one of the advantages of an FHA loan are the lower origination fees and the lower insurance, the MIP, the mortgage
Okay.
insurance, as opposed to say a conventional loan that's going to have a 5% down payment. Now if you're a veteran, veterans have 0% down payment. And if you're a veteran that is 100% disabled, you have zero down payment and zero origination fees.
Wow. That's very
Yeah.
good.
So
They
there's
deserve
some
it.
big
I mean I
advantages for
mean,
veterans.
anything I love things like that, you
We
know?
also offer, discount origination fees for first responders and school teachers.
That's
So your
good to
fire,
know.
your police, your EMS, nurses, and then school teachers, we offer discounts for them as well.
Well,
So
let me ask you before we get too far, because I'm a talker. We're talking about the interest rate now, what would be the difference? Like if I'm putting 5% down conventional, or if I'm putting 3.5% going FHA. If I'm not mistaken, conventional is a little bit more laxed on some of the things versus the appraisal. Like if they go in and I mean on
yeah,
a conventional, you may have a little bit of rotten wood here or there, something like that, or need painting. Those seem to go a little bit easier for that type because not every house is going to qualify for a FHA loan.
that's
And
right.
that's where we
So
have a lot of issues with first time buyers because
mhm,
if you're a single parent and to be able to, I mean, let's just say probably around 150, $150,000 or less would probably be a comfortable note because you
mhm,
are everybody or a lot of people may not know. I mean, we do this all the time, but a lot of people you can only maybe buy one house in your lifetime, maybe two or three. But when you're going as far as the interest on those type 2, is there a difference? And what would
Absolutely.
you consider the 10-year versus the 30-year?
All right, well, you've asked a few different questions in this,
Yep,
so let's hit them up. So, first of all, a good rule of thumb to remember is the less money out of your pocket, the better condition the house needs to be in. Okay,
right.
that's
Okay.
so. So let's start with a conventional loan, which is a 5% down payment. They are going to be way more lax. So you've got some peeling paint, you've got some missing flooring. Let's say they pulled the carpet up and it's just a slab. Let's say you're missing the water heater or a stove, or the air conditioner. Those things are going to be able to be worked with on a conventional loan. If you go into like an FHA loan and it starts having missing appliances, missing flooring, they're going to be no, the home needs to be in livable and safe condition, right? It have to be up to date. So if you're looking for a money maker, but you don't have a lot of money to put down on a house, what you want to look for is you want to look for your grandma's house. It's got the old shag
Mhm.
carpet, it's got the linoleum floor, it's got, outdated countertops. Well, that's your moneymaker because that's going to be the house you can move into because it is safe and livable, but you
Right.
can update it while you live there over time. And then when you sell it, you can realize those profits, and move that into your next home. If you go on and keep moving on down the line, FHA is 3.5% down payment. Well, now when you go into a VA is no down payment. And let's couple in with the VA, the USDA loan, which is, we'll get into that one in just a second, but it's also a 0% down payment. And when you look at those with a 0% down payment, there can be no peeling paint. There can be no missing anything. It needs to be, now again, it can still be grandma's house, but it has to be safe, livable, in good condition. No rotten wood. The roof needs to be in good shape. All the appliances, all the mechanical, everything needs to be in working order. VA gets strict sometimes, even with like if there's a shed on the property, there can't be any rot on the shed. Can't be any peeling paint on the shed. The fence has to be in good shapes. It
I
gets
painted a shed 2 years ago.
right.
Serious.
So
I mean,
it gets
the
tough.
seller was in California, so I'm like,
That's right.
"Hey, Mr. Seller, we got to have the shed painted. Are you okay if I go do it?" It was a weekend, it was
That's
pretty weather, it was springtime, so I went and I painted the shed,
well,
but
you're
that was the
right.
only thing that held us back was the darn shed and
That's
a chicken
crazy though,
coop,
isn't it?
but once we got that no problem. Let me go back on one thing. You mentioned USDA. Now that's not I know that's not considered a military loan. It's VA is the
Yeah.
only military loan, correct?
Right, and I did wanna go into USDA because we kinda skipped that when we were talking about the different loan types. So a
Mhm.
USDA loan is a fantastic loan program, but it's very specific. So it has a map in which the house must be located within their geographic regions. It's called a USDA loan because it is backed by the US Department of Agriculture. That is who insures the loan, the funding for the
Okay.
loan. And because it's through the Department of Agriculture, it's a rural development loan, so it's non-populated, so it's not gonna be in any cities, it's gonna be in smaller communities. Now, it can be in smaller cities. You're not gonna find it in Gulfport or Biloxi, but you will find it in Vancleave, and Vancleave is a city. You will find it in
Alright.
Moss Point is a city. Pascagoula
Now,
is
is any in Pascagoula USDA eligible? At one time it was, but I
it
think they changed the maps
had they
about 8 or
changed the
9
map?
years ago, it seemed like. Because I know, like, Hickory Hills, once you get, like, a little bit north of I-10, going up and even into Goche, a lot of
Yeah, they
that
keep shrinking the map.
is USDA
So
also, or used to
So if you
be,
go to USDA.gov, you can type the address of the property you're interested in it, and it'll tell you if it's in within the eligible area.
or they can call you
Or they can
with the
call me,
address. That's what I
or
tell
they
a
can
lot of
call
people,
you.
if we're not sure, just call me with the address,
That's
and
right.
we can have somebody that will know to answer it.
Absolutely. What else do we wanna hit on USDA?
And now that's almost 100% financing.
It is. It's 100% financing. Now, don't get 100% financing with there's also closing costs. So it's not
Mhm.
no money out of pocket.
I
So with
got you.
all of these loan programs, when we say there's 100% finance or a 3.5% down payment or 5% down payment, that's not the end of the cost. Okay. Starting out, you're going to have an appraisal fee, and that's going to be paid up front out of pocket. Depending on what state you're in, and what type of loan it is, will determine the fee of that. But they're going to run between $500 and $750, somewhere in that neighborhood.
Now
If you
that's
do a
usually brought back at closing, isn't it? Is that
what's that?
is that y'all collect that up front, or is that
That
part
is
of
collected up front. That is collected before the appraiser goes out. He gets
okay.
paid no matter what.
Well, now the appraisal is not gonna go out until the house is ready for that appraisal. I mean,
Right.
I don't like I said, like, the other day I had one, and I mean, it was just so fast. It's like we went under contract, and then we had a home inspection. Then the appraisers wanting to go out the next day after the home inspection. So I'm like, well, I'm going to hold the appraiser off because if this home inspection is not the greatest and the buyer wants to back out, I'm going to advise my buyer to back out and not spend the money on the
Exactly.
appraisal because you've
Exactly. So
done
let's
spent
talk about
almost
that process.
400.
So let's
Okay.
talk about that process a little bit. So as your realtor takes you out, you find a home. Before your realtor takes you out, he should take you to a mortgage lender, and the mortgage lender is going to get you pre-approved. And pre-approval
Correct.
is going to say, hey, you can comfortably afford this much home, and it'll roughly cost you this much a month. Does that fit into your budget? Now, what's going to affect those are going to be how much is the insurance? How much is the taxes? Is it in a flood zone? Does it require flood insurance? So there's some, extenuating circumstances that we have to know a specific home to give you the number for. Pre-approval, this is roughly your budget. Now you can start shopping. You go to your realtor, y'all start shopping for homes within the budget. Once you find one you like, you call your mortgage lender back up. You go, hey, we love this home. And the mortgage lender is going to say, all right, let's get you an insurance quote. Let's get you a check on the flood. Let's check on the taxes. Let's work it up. All right, this is what your monthly payment's going to be. Does that work for you? You're pre-approved for that amount. Yeah, that they're comfortable with it. You write your offer. You get your pre-approval letter from the lender. You submit all that. If negotiate it. Once it's under contract, you send your contract to the lender. The lender is going to start working on the underwriting part of the contract and gathering the documents, the supporting documents to go with the application you filled out. And your lender is going to order your home inspection, not your lender. Your realtor is going to order your home inspection. Once the home inspection comes back clear, your realtor is going to call the lender and say, we're good to move forward. We're going to order the appraisal. Once the appraisal comes back, it goes to title work. Once the title work comes back, you go to closing. So that's the real quick dirty of the process.
30, 45 days usually, depending
Uh,
on the
you know,
market.
again, it's all relative to the market. I'm seeing them close 20 to 30 days right now because the market is slower and the underwriters and the appraisers and the inspectors are able to get to things much faster. As the
Right.
market gets busier and their files start backing up, that time starts that lead time starts going longer.
Let's say I call you and I got a buyer, and I mean he is right there at the credit score, and still, and like his wife, they're married. Okay, he's got good income. She's got the best credit though, and she's
Mhm.
stay at home because she's got 4 kids. So it's kind of, is she going to be on the loan as well, or do you use other sources of income, or is it usually primary on one person as the income, or
Credit without income is
well, you would have the husband.
right, but you have to use the credit of the person that has income. So if she has no income,
We have to stick with him. We'll
right, we gotta
stick on
stick with
his
him
income.
and his
Alright.
credit.
So
Now, if
she's
he's close,
babysitting kids, $200 a week.
we have
Can
to
that
show
be
proof of
added?
that income.
Okay, okay.
And to back that up, that becomes now a self-employment thing. We're getting into the weeds here. It becomes self-employment. Now I need 2 years of that proof of income, and I need to know that it's going to last for 2 more years. So funny you should say that. Let's talk about child support, right? So
Oh,
if you're
yeah.
receiving child support, we need to know that that child support is going to last another 3 years, right? To include that to count toward your payments. If your child's say 16 years old, we're not going to count the income from the child support towards your income because that child support is going to end with before 3 years.
Okay,
It's not going to count against you. I just not going to count it for you.
okay. Now, I know I'm asking a lot of questions. As far as the different type of loans, do y'all's branch, do y'all do y'all do construction type loans? And could it be where they actually kind of live in, how people are building these barn dominiums, they're building like, so if they're wanting to redo this house, they have one room that works in the kitchen that they're just using. They're living in it while they redo it. Is that a type of loan they could work with? Or do they have to be out of the house while the construction process is going?
No, those are two different types of loans.
Okay.
So if you want to, let's say you own land and you want to build a home, that's a construction loan, and there's a whole process for that. We have to have a set of plans. We have to have an approved contractor that's going to do the building. Of course, it has to be up to code and everything approved. And then that's done on draws. So as you submit the set of plans, the plans get appraised. So we have a value to what the house is going to be at completion. So we know what the loan amount can be. and then we loan it out in draw. So let's say your first draw is going to be we're going to clear the land and pour the slab. So here's the money for that. You clear the land, pour the slab. We come out, we check, go, yep, he cleared the land, poured the slab. The money was used for what he said. Here's your second draw, and then you do your framing and you black in the house. All right, well, there's the money for that, and so on and so forth until the house is completed. Blacking in a house is putting the walls up, putting the roof on it. Now it can't get wet on the inside. And then you start the
And these
inside.
need to be licensed contractors that are doing the draws, and most, I would
More than
assume.
licensed, they also have to be approved by the lender. And a lot of times that is nothing more than them submitting a copy of their license and their insurance and, that, hey, they are legit.
So as far
So,
as your escrow, taxes, insurance, and then if we have a flood, that's additional insurance, right? So all
all
that
right,
is escrowed. Am I missing anything? Taxes, insurance, and
principal and interest,
oh,
PITI,
okay,
principal, interest, taxes, insurance. That's right. That's your total payment. Let's go back to the construction thing real quick. Let's go renovation loans, right?
okay,
So so I mentioned that was two different things. So let's say you're living in your house and you want to remodel your kitchen. All right. Or do an addition,
yeah,
either one, anything like that. That's a renovation loan. And what we can do on a renovation loan is let's say you want to do an addition on the house. We're going to add square footage. We're going to add value to the house. So we can submit those plans, right? So just as the house is valued at its current condition, we can tell you what it's going to be worth after the renovation and loan you the
okay,
money to get it there. Right. And that's called a subject to appraisal. And on that subject to appraisal, it's subject to completion. And now we can lend you 80% of the value of the completed project. So that gives you the money to get it to the value with 20% equity left in the project.
okay. That's good to know. I mean,
So
I
let's say you
get.
have a seller that needs to do a bunch of work to the house. Well, they can do a renovation loan, fix the house. Now they have a house they can sell that'll meet the qualifications of, say, an FHA or USDA, or you know what I mean?
Mhm.
So what I've run into is I have, people that have homes that they've inherited and they're just in terrible condition. So they're forced to either sell them to an investor for a cash buyer,
Right.
or let them go. And it's like, well, we can do this renovation loan. You can fix the home and then sell it.
Now, can that be escrow? Like if I have a buyer, okay, my buyer is going FHA, and I found this house that's conventional, and it needs the only thing it would need to pass, in my opinion, would be a new roof. And if I got a roofer that would say, "Can we escrow?" Like if I get a roofer that says $1,000 and put a new roof on this,
Hmm.
can I get receipts and bring deals and say, "Look, can we not escrow this $8,000?" So you see what I'm saying? To redo
It,
the roof after the house closed. Is that such a thing?
yes, but it's a very specific situation that can happen. It's just not a blanket. Yeah, we can do that.
Okay.
It's specific to the type of loan, right? And it's also specific to the roofer has to be licensed and the whole nine on the list. It becomes a whole thing. The easier way to handle that is just either have it done as part of the closing settlement. Hey,
Mhm.
the attorney's just going to hold the money from the sale, the proceeds to pay the roofer.
I'm ki it is on conventional versus VA, not VA, conventional versus, FHA loan.
Hmm.
Is there difference? Does my credit score need to be higher, and are the interest rates cheaper in either one of those? I mean, as far as, like, if
All right, just
I
like
have
we,
a s
yeah,
yeah,
yeah.
like a
Just
600
like we
credit score,
Yeah,
620.
just like we talked about before, when the condition of the house follows the type of loan, so does the credit score. All right. So the more money they're giving you, the higher your credit score needs to be, or the lower your credit score, the higher your interest rate is what
Okay.
I was trying to say.
And
So
does that work with insurance? I've heard insurance agents say that a lot of time that
absolutely
goes on
does. And
credit.
I'm not an insurance guy, but I've
I
heard
don't
that
know. Me
many times.
neither. Me neither. I just heard some people, and I didn't know that until a few years ago that that's actually a thing with insurance or credit. What
It
kind of
is,
credit you have?
but there's 2 types of credit now. So you also have an insurance credit score, and that's based on how many claims you've made and how long you've carried insurance,
Oh wow! See, I didn't know
and
that.
your actual financial credit score plays into that too.
If you're pulling, is it a hard pull on my credit? Because a lot of people call me and say, "Look, I got
Great
pre-approved through
question.
this online bank,"
Great question.
and they're
So
out of. North Carolina, and they can't lend in Mississippi. Well, then they come here and I can't get them approved, and they're like, "Well, why was that other agent in North Carolina or South Carolina able to approve me, and we can't get approved? I'm like 2 points away." There's things we can do that you can help with pulling up 2 points.
Mhm.
Maybe a
Uh,
little slow process, but
sure, let's talk
yeah.
about that a little bit. To pull credit up is difficult. It's very easy to let your credit go down, but it takes time to pull it up. It's not an equal it goes up as fast as it goes down, right? But there are things you can do on your credit that will help you. One is don't use more than a 10% of your available balance on your credit cards. And let's say you have a $2,000 available credit limit on your credit card. Don't ever let your balance be over $200. And that
Okay.
shows your available credit at 10%, yeah, at 90%, right? That'll help your debt to income tremendously.
To
It'll
pay it
also
off
help your
every
credit
month
score. Pay it
or
off
pay a
every month.
little,
Yeah, pay it off every month and then just put a little bit on it every month. Put your gas on it every month. But
and that
that
would help
revolving
showing
credit,
I'm good with making payments
that's
in the
right. It shows
the
credit
line of
history.
thing. Okay,
Yep.
because if you had somebody coming to you and it happens because a lot of people still pay cash for things, and about the only credit they have is their cell phone or their insurance on their vehicle and things like that. What would you suggest to them to start building their credit to be able to have enough credit to purchase a home?
A secured credit card works really good, which is
And
basically
when
a
you say
prepaid.
that, that's like a bank, like you can go and put 300 in a checking account and it gives you a
Mhm.
debit card and you can only go up to what you have available in your account, if I'm
Right.
not mistaken.
That's
Would
exactly
that be
right.
another 10% thing on that as far as like you're saying on that credit card, just do 10% of the 300 every month and
Not on a
pay it off?
secured one because that's your money.
Okay. See, good to know.
Yeah.
Very good to know.
But on a revolving credit, and that's the way it'll show on a credit report. It'll say revolving credit, and those are the ones you want to see at a 10%. On a
With
secured, it'll say secured credit or secured loan.
the older I get, things just go right out there. I'm not just right out there.
All right, so hang on a minute. There's a question I want you to ask me. Let's talk about buying timing in the market right now. Is it time to buy? Is it not time? What do I think the market's doing?
Okay. What do you think the market's doing? Just out of curiosity. I mean, I work with a lot of investors that like to flip homes, to buy them and
Mhm.
flip them. But to me, unless you're getting a steal of a deal and you're able to do a lot of the work yourself, flips are really hard to do right now. What do you think on? But now, if you're doing it to live in it for the rest of your life, you're not trying to buy it, flip it in 6 months. You're going to live in it. So hopefully, 10 or 15 years down the road, when you go to sell it, boom, you know you get your money back plus a lot more versus trying to flip a house, I would say. I think that's
What I'm seeing in the market is right now we're seeing interest rates starting to creep down. And what I'm hearing from people is, hey, I'm gonna wait on interest rates to drop before I buy. Well, why? Is the reason I ask that. Because what happens is as interest rates drop, the prices of homes go up. And the reason that happens is as interest rates start buying, all the buyers that are sitting out there that are doing exactly what this buyer was doing, I was talking to on the phone is saying, I'm waiting on them to go down. Well, when they do go down, everybody runs to the market and the homes that are on the market get sold real fast. And then all the sellers say, oh, now is time to sell my house because the prices are better. And this one sold for this, and they come in and they price their house just above the other one. So as that interest rate is creeping down, that price is creeping up. Well, if you jump in now as a buyer and you jump in and buy this house now at an interest rate that feels too high, as the interest rate continues to creep down, as it goes a point, point and a half, or 2 points lower, it's the perfect time to refinance. So you refinance it in 6 months, a year, year and a half, whenever it bottoms out, and you realize all that free equity in the home for dropping just the interest rate. So if you
fine.
look at that versus, well, I can buy this home and let's just freezy numbers to say it's at 6%. I can buy this home at 6%. I can buy a point. Now I'm at 5%, but it cost you $2,000 to buy that point or $4,000 to buy that point on a
I mean, that
$200,000
seems like
house.
money well spent if you got it.
Well, that's true. But if you can buy it at that and in 6 months refinance it and be at five, then that's
Yeah.
free
So
money.
at least 1 point, you wouldn't refinance for like half a point. Need to be
No,
a
no, no,
point
no.
or
At least a
higher.
point. 2 is ideal, but anything close to it, a point and a half, anything more than a point is worth refinancing. And what we mean by why it's worth refinancing is because the closing cost is gonna how much time at the new payment and new rate does it take to recoup your cost to refinance. All right. And at
Okay.
1%, it, seems to be a reasonable amount of time. At 2%, you're making money.
Yeah.
And
Now,
so the other question that I ask people when they come to me and want to refinance for is how long do you plan on staying in this home? Because if you're not going to be in the home long enough for you to recover the cost for the refinance, then what's the point in refinancing? You're losing money. But if you're going to be in the home for many
right.
years and you can realize that savings, then it's worth
Mhm.
doing.
Oh, no, I totally agree, and I get tickled because it's like people I'll hear them in the office over there talking about, "My god," and I remember the parents talking about 17%, 18%, but and then again, you look at the price of a new home back then,
17,
you know?
18, $20,000,
Yeah, and so it's
$30,000.
kinda like it's almost the same as what we're paying now, it's just a different way of structuring it,
Correct.
so to say.
Yeah, they were paying a
Uh,
pile in interest, but not much on principal, you know?
right,
Where they had the big advantage is
exactly.
their insurance was very low.
I'm telling you, and then
Insurance is hurting us more than anything.
debt to ratio, we hopped on just a little bit, and I think you mentioned, like, so that's when, like you said, the child support is used and
Yeah, let's
everything
just talk
else, but
about what debt to income ratios are, not necessarily what the
perfect.
numbers need to be because that gets way into the weeds. That's something that we take care of because different loans require different debt to income ratios, right? So
Okay,
based on the loan program, is going to tell you what the debt to income ratio on that program is, but that's way too in the weeds for what we need to do. What we need to understand is there are several factors that go into getting a mortgage approved. Okay. A debt to income ratio, and that is how much debt do you have versus how much money do you make? So, how much money do you have left over every month to pay your bills? So, when we start looking at your debt to income ratio, and let's say you're a renter, then we're not gonna count your rent, or you're not gonna count your power, we're not gonna count your utilities because you're gonna have those wherever you go. So your rent is gonna become your mortgage. Your utilities, you're still gonna have utilities at your new home. So
mhm.
those transfer to the new property. So that's not really gonna hurt you. But what we're looking at is we're looking at credit cards, we're looking at medical bills, we're looking at car payments, we're looking child support payments, whether you're paying them or receiving them.
A old cell phone bill, you thought that would go away.
That's right.
It's gonna come back and get you.
Yeah,
Just
yeah.
know.
There's no way, yeah. Just because you dispute it doesn't make it go away on your credit.
No, I mean, I get tickled with it because this makes me think, and that goes back. I mean, somebody had an old phone with you remember the beepers or the
Yeah,
pagers?
yeah, yeah.
One of those that they have not paid for like 30 years or 40 years, you know? And I'm like, you got to pay it. It ain't going away.
Mhm.
Yeah. Oh my God, we've come a long way since the little pagers, haven't we?
Haven't we? I mean, you don't remember going to the other real estate offices and picking up the keys and having to return them?
Right? Well, I'm glad you said that. We haven't said it a whole lot, but you are also a broker, realtor here in Mississippi, and you are retired.
On another day. What else we wanna
Okay.
hit on real quick while we got you?
The current market.
Well, we
I mean,
talked about
I
that.
think inventory's down
So
like in some of
let's
the
talk about
smaller
inventory.
towns.
And the reason that we're seeing inventory where it is while the interest rates are where they are. So historically looking, when interest rates are where they are right now, this is typically a hotter market than what we're seeing. And the reason we're not seeing the hotter market is because of what happened in the past. And we have people still in 2 and 3 and 4% interest rates that they want to move, but they're not willing to give up their interest rate. So
Right.
they're deciding to stay because of an interest rate. It's an
Mm.
interest rate.
That's a hard one.
I'm not gonna let an interest rate dictate the joy in my life,
No.
but
And that's what I tell my
but
buyers all the time. It's like they
there's a
wanna
lot of
look at these
people that
beautiful
do.
properties.
Yeah, and there's a
Yeah, I mean,
lot of
'cause I mean,
houses.
I don't wanna have to work 2 jobs, or I don't have to work all the time and don't wanna worry about it if I miss a house I can't show because of whatever. I still wanna be able to pay my bills, and I wanna be able to enjoy myself. I don't wanna have to struggle to work all this overtime, like a lot of
Mhm.
people. I can afford it if I pull an extra 2 shifts a month. You don't
No.
want to be positioned that you're that close
Right, you
of your
don't wanna
debt
be house
ratio.
poor. So,
But I say anything you want, but I'm gonna give you my opinion, and I'm gonna tell you a lot of it is, especially, because I deal with a
well,
lot of
and I'm
young
talking about
people, first
sellers,
time buyers.
these
Yeah,
sellers don't wanna give up those low interest rates, but they wanna move, you know?
right.
They either wanna
And
downgrade
that
or upgrade.
seller is gonna make us a lot of money on the house he's bought, because if he's already had it 5 or 6, 7 or 8 years,
Right, and
they're
that's
gonna make good
another thing
money
that
on
we've
it.
seen in the market, and it's kinda settling down a little bit, but what we saw in the market was we had a huge inflation spike in home value, and what we saw was people bought in these homes, and then the price went through the roof when they're like, "Man, I'm gonna sell this home and realize all this equity I have," but you can't replace it
No,
because all the homes went up that much.
that's right.
So we ran
Now
into
you're
that
totally right.
over and over and over and over. "Hey, I got all this equity in my house."
Mhm,
And the reason I bring that up as a lender is you can't buy a home with equity. You can use the
right.
equity as a down payment, but it's not income to qualify you as a buyer. And that's what people
Okay.
don't understand is they go, "Well, but I have all this money." Yeah, but I can apply that money to the purchase and bring the purchase total down. But that money is not income to qualify a person as a buyer. So if their debt to income ratios are maxed out, that equity is not going to help. I have to use that equity to pay off their debt to open up the debt to income ratio. I can't
Yeah.
use that. You see what I'm saying? And once I explain it, people go, "Oh yeah, that makes sense." But in their head, they go, "Well, I have all this money in the value of my
Mhm.
home, but that's not an income. That's equity."
Well, have you noticed, or have you been getting any? I've started getting calls because, during COVID, which I was very surprised. That was probably one of my busiest years. It was crazy. I mean, here I am thinking, I just did foot surgery in December, so I would be out for January and February, and
Mhm,
be recovered and ready to go by spring. Well, darn, I had the foot surgery, then COVID, they shut everything down. So I'm like, this is not gonna be good. And lo and behold, I mean, it was crazy. I mean, we had so many people moving here, which I'm grateful for. A
mhm,
lot of people coming to the beautiful Mississippi Gulf Coast. And a lot of people, yeah, even from California. It's like California and Nevada and Colorado was shifting this away. And when I talked with some of the people, they're like, well, we sold everything and now we're in an RV.
mhm.
So I'm starting to get people that, because okay, back to the COVID, it said you can work from home, and then when they said you can work anywhere from home, so you got a market like a California market was so much higher than what ours is.
Right.
So those people were selling their houses with cash and then coming on and buying. Surprising, they were so surprised at what they could get for $200,000 or $300,000, even something on the water,
Mhm,
and this close to the beach. So that was a great year and that was a busy year. But it seems like now a lot of that, because people were, RVing and living their life that way, like especially like doctors and or nurses and all that can go do these contracts, for 3 or 4 months in these different areas. I've noticed some of those people are starting to want to get out of their RV and just keep their RV as a secondary, take it and use it to travel because it's paid off, and they're wanting to start buying a house again.
mhm.
Um, so even at 70 years old, they would still a lot. I mean, they have the down payment.
You wanna hear something
I'm
really
not sure
cool
where
about
I'm
that?
going with this, but it seems like a lot of people want to have a home base now.
Mhm.
And right after COVID, they're like, I can go anywhere. I can get my mail anywhere. So it's kind of like, I don't blame you. I'd travel too if I could.
So
It's kind
let
of
me
deep.
give you a little cool tidbit that we can do to help them. Right? If they have not owned a home in 3 years, they're
First
considered
time?
first-time home buyer.
Yeah.
So you can be a 70-year-old first-time home buyer.
Well, I mean,
So if he
and that's
yeah.
people have like, I get that. I mean, even like people that go overseas and work overseas, they might be here a month or on a month, off a month.
Mhm.
And some of those people are 50, 60 years old. And like they said, they've never bought a house. I'm like, well, if you've been working this hard, you got to have some bank put up. So,
That's right.
you know, but I still advise to get with their tax person or loan officer, because to me, there are benefits of paying a mortgage as far as your taxes, your income taxes and stuff like that.
Mhm.
Because I want to say the house is, well, about the only really good thing that to write off as a single parent or a single adult even.
Yeah, I mean, yeah, we talking about write-offs, we need to definitely talk to a tax professional on that. But on the mortgage side of it, I don't know what the hell you want me to say to this, Patrick. I
I'm
don't know how
just
to
curious
respond to
on
that.
that.
Huh?
Yeah, I'm curious about that.
About what?
Well, I was just asking. Now I done lost it. See? You did it.
I didn't
Squirrel.
mean to.
I didn't write it down.
As a single parent, the writing off what in the taxes?
Their taxes, their house.
It depends on how you structure the purchase of the house as to how you can write and what you can write off. So if you
Okay.
put the
'Cause
house in an
I've
LLC,
always been able to write the house off, and that's about the that was the only thing that helped me a lot with my taxes usually. You know,
you get
even when I was
mortgage
working at
interest
the
you can write off.
casinos and all that.
Well, you can write off your
Sir?
mortgage interest and your homestead exemption. Those are the
So
tax.
that actually helps people. To
That
me.
does. That does.
Yeah, and that's why I'm saying, with the tax person, they could probably tell you, yeah, you made $400,000 from the sale of your grandparents' home. Now you probably need to do something with that for that $100,000 so the taxes aren't hit. I mean, I don't know. I know like some of the times they'll tell
Well, that's
different people you need to spend it within 2 years
well,
to avoid capital gains and all that taxes.
uh, let's back up because you kind of get into a tax world. But what you're looking at is if you're selling, and I'm talking about someone buying a personal residence with the homestead exemption
Mhm.
and writing off the tax mortgages. If you're talking about you inherit your grandparents' house and you sell it. Well, now what you want to do is you need to hold that house. You need to talk to a lawyer and tax people, but typically what you want to do is you want to sell that house and do a 1031 exchange. All right. So that what that is a tax deferment. And on a 1031 exchange, there's a certain amount of time to make the exchange happen. But what you're doing is you're exchanging it for a like or greater property. So let's say you got grandma's house and it's worth $400,000, but you want to become now an investor, and here's a duplex over here for $400,000, right? Well, now we can sell grandma's house, not pay the capital gain tax on it, buy the duplex, and that capital gain tax defers to the duplex. So when it's sold, that tax becomes due at that point. But if you don't sell it, it never becomes due.
Okay.
And you can continue to defer it as you are continuing to upgrade property. So if you say I'm going to sell a duplex and buy a fourplex, now you can defer it again. So as long as you're staying in the same or better. So,
Okay.
but again, talk to your CPAs about it. That gets
Oh
into
yeah,
a whole
definitely,
different legal
definitely.
world of
That
how that's
stuff,
done.
I don't know how. I mean, it's just things I hear from different buyers and
Yeah,
sellers. Some of their hiccups that come back a year later or two, and they say, "I didn't know I needed to spend that," And of course, I tell as soon as I start working with somebody, I'm like, "Do not change your credit. Do not go buy a new car. You don't do nothing until you close, and then when you close, you go to Lowe's and get a credit card, and then you do the damage you need to do."
right,
But if you can pay it off within 3 months, usually Lowe's gives you a 10 or 15% discount when you sign up for their, credit card. So, this is after you close.
right.
I tell everybody, go to Lowe's, sign up, get that 10 or 15% off because you're gonna see stuff you want. I mean, a lot of people moving out of apartment, they don't have a rake, they don't have a water hose. They don't have a trash can to pull the stuff to the road, so they don't have to go shopping. So that's why I always say, when you close, you can go to Lowe's, but don't do nothing else. I
That's
had a
right.
buyer stop by one night in a brand new car. Look what we just went and bought. I'm like, no, 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 no. I
Take
mean,
it
you're
back.
closing Monday. It's a Saturday. You just went and bought a new damn car. You're not closing Monday.
That ain't good.
Luckily, like I said, they pulled up in my driveway and I'm like, holy shit. The note that the new car they bought was actually $10 cheaper a month than what they were paying. Luckily, I mean, because they were
Right,
signed, everything was signed. It was done. It was their car. But thank God, it was the same money
right.
basically. It was just a brand new car, which really freaked me out. I was like, oh my God.
So as a lender, let me talk about what we look at it from that. So we
Okay.
take a snapshot when we pull your credit and we do a pre-approval. We're taking a snapshot of your financial situation at that moment in time. All right.
Is that considered a pull?
Yeah. So what we
I hear that a lot, because it's like, dude, I don't want them to pull my credit.
okay. There's
It's
two
gonna
types.
have to be pulled.
There's two types of pulls. There's a soft pull and a hard pull. The very first
Okay.
thing we're going to do is a soft pull. All right. The soft pull is going
And
to
that
show,
don't bother it, or
huh?
the soft pull?
Yes, we're gonna run
Okay.
a soft
The
pull
hard.
first. If the
Right.
soft pull shows a good credit score, then we're gonna proceed. If your soft pull shows a credit score that's not gonna get you there, we're gonna stop right there because we don't want to show anything derogatory on your credit by inquiries. And an inquiry is every time someone pulls your credit, it shows a hard pull, it shows an inquiry, right? So
Okay.
soft pulls don't show inquiries. So we do the soft pulls. We get a little snapshot of what we're going to be seeing. It shows us what's on the credit report. If there's anything derogatory, how many mortgages there are, how many loans there are, how many secured, unsecured, all that stuff's on the report. Then we can know, all right, we can proceed with that. If we proceed with it, then we do a hard pull to see because it's going to use 3 scores instead of one, and it's going to take the middle score. We take that middle score, and run your debt to income calculations, figure out what it is. That's how you get approved. If the credit score is not where it needs to be, we're able to see what's on there and we kind of coach you and say, this is where we're seeing the problems, get these fixed. This is how you fix them. Come back and see me in 6 months. We'll do another soft pull, see how much you've come up and get you there. But it really is going to come down to the borrower doing what they need to do to get it there. We're going to tell them what they need to do, but it's up to them to do it.
Um, that's definitely
So
true.
that snapshot that we look at, right, needs to stay the exact same until you buy the house, until you own it. So let's say you come to me today and you go, hey, I want to start shopping for a house, but you don't have a house picked out. Well, I'm going to run you a pre-approval. We're going to get you there. You're going to know what your budget is. Patrick's going to take you out. He's going to show you all the houses. You don't like any of them. You can do this for weeks and weeks and weeks until you find the perfect home. And once you find the perfect
Okay, you gotta as soon as you see one house, you gotta buy it.
as soon as you find the perfect home, you're ready to go. As
Yeah,
long as you haven't done anything other than just pay the bills that you already had,
yeah.
do what you normally do, but don't buy furniture, don't buy a car, don't open any credit cards, don't close any credit cards. Don't change what's happening without talking to the lender before you do it. And what
I tell
we
them
can do
all,
is if you
"Don't
say,
do
let's
nothing."
say you go, hey man, my transmission blew up, I have to have a car. At that point, I can run some numbers and say, go find you a car, but your payment cannot exceed X number of dollars or you can't buy your house. Right.
That's good to
And I
know.
can help guide you through this life problem without ruining what you're trying to do down the road. Just because a curve's thrown in there doesn't mean it's over. But we have to communicate it and figure out the solution so we can do it all. So we can buy the house and the car. Make sense?
Yeah, with me, and to be honest, I know a lot of people are still doing I'm about half and half on what I do online as far as paying bills and things like that. I'm not converted to the 100%. I still have a checkbook and I write checks.
Mhm.
So I'm halfway there. But to me, going online, it kind of makes me nervous when you put in an application. I can't think of any of the bigger that's everywhere, you know. All right, so I'm gonna go on this website and I'm gonna put in all my information to get a pre-approval. Okay. Now that pre-approval versus what would you say it's about the same pull? Or would you I advise not to do it, to go to a lender. I tell them not do their
The
credit
quality of the
online.
pre-approval is not the same. The
Right.
soft pull is gonna be the same, right? The quality is not the same. There's very, very few unless the borrower omits information to us on the application, it goes through. On some of
Yeah.
these national Dollar General style, they're everywhere kind of people, the lenders,
Every 3 miles you get Dollar General.
that's right. What they're
Mhm.
doing is they pull your soft pull. If it's anywhere close, they go, yeah, go ahead. And then once you submit all your documentation, you're finding out I'm not qualified, right? Or now I have to scramble and borrow $10,000 from my mom because I didn't have what I needed in reserves. Or, it turns into a mess of a deal because you didn't prepare correctly and get your ducks lined up to know
Mhm.
that you're ready to do what you're trying to do. And that's where a quality mortgage broker is going to help you versus an online lender. You know what I mean? That's just,
Right,
you
right,
know what
and
I mean?
I mean,
I am
a
going to give you
lot
an application online to fill out and we do work through the internet as far as a portal and it's a secure portal and it's, you got to log in and put in passwords and, it's encrypted and all that stuff. Just no different than DocuSign. It's as safe and secure as that. But I'm also in Pascagoula. Like, so, we can sit down face to face as well.
yeah,
Yeah.
yeah.
And that's the difference. And I'm going to give you a good quality of pre-approval because I'm going to look at everything, not just a credit score. I'm going to look at your debt to incomes. I'm going to look at, your bank accounts. I want to see how long you've been on your job. That's a big one. If you've changed jobs, are you in the same type of industry? Because if you're changing and you went from, I'm a dog groomer, now I'm an accountant. Well,
Lord.
You know what I mean? Like, you're all over the
Yeah,
map. But if you're an accountant here and then you're an accountant here and an accountant here, well, then you're in the same field. You're an accountant.
it's funny. I had a police officer that went from policeman to truck driver.
Er, Not the same field.
So that I think they had to wait about a year on the income from that. What is usually say if you got and I know we talked a little bit on it, if we need to do just a little bit, or if I'm looking to, I want to buy my goal is to buy a house in 2 years.
Mhm.
I still, even though it's 2 years out, I advise to them to go ahead and speak to a loan officer and try to get just ideas of ways to make sure that they're going to be ready in 2 years to buy a home.
If they're gonna buy a home in 2 years, they need to start saving money, right? And they need to make sure that
Oh
their
yeah.
bills are paid and paid on time, and they don't need to incur a bunch of debt. When they get 6 months or a year out, it might be a good idea to go ahead and do an application in a soft pull just to verify that they're on track to be where they wanna be when it's time. The other thing I tell people is it's never too early to start. So if you wanna buy a home in 2 years, what's wrong with starting right now? And the reason you wanna start right now is because markets fluctuate. We don't know what's going to happen within the next 2 years. So let's say we have a dip, right? Or let's say the house that you really want hits the market within those 2 years. I've always loved the house on the corner of, such and such. It just went up for sale, right? Now you're
Right.
scrambling to put yourself in the position to buy your dream home, or you're in the position, let's move our schedule up. We're ready to go. So if you have the idea that I'm going to buy a home, then go ahead and talk to a lender, know what you're looking at, know if there's things that need to be corrected, you have time to correct them. And if not, you're sitting on go and you know what you can be saving and what that's going to look like. So if something pops up you really want, jump on it. It
Yeah, no,
just
and
makes
that's
life easier.
just be planned and be
Yeah, that's right.
ready. Yeah,
Pre-plan it
because I
out.
know a lot of it's like things life changes daily, how well we
For
know.
real.
I
Yeah.
mean, daily, so, I had shows today, all they got rearranged and canceled till Sunday, so
Right.
it's like and we just kinda go with the flow, you
Or
know?
let's say we have another dip in the market, and let's say we have a hard drop in interest rates, you know what I mean? Then you're sitting on
Right.
go. You can boom, jump on it real, you know what I mean? So,
What's the rate right now
uh,
about? Have you
well,
pulled it?
the rates fluctuate. So as a lender, we're taught not to answer that question, okay? And the
Right.
reason we're told not to answer that question is because rates are based on individuals' credit scores, individuals' debt to income ratios, individuals' credit history plays into what their interest rates are going to be. But right now, a 30-year fix, the prime, you're looking at 6.1.
Uh,
So,
it's not crazy.
no,
I don't think that's high.
I think that's a normal rate. I think
Yeah.
5 to
Oh, yeah.
7%, there's
Mhm.
no reason not to buy, you know what I mean? That's not crazy high, but it's not a fire sale either. I think it's the perfect rate to buy, to plan or refinance when the interest rates drop, because if they start dropping below 5, the odds of getting it to drop low enough to refinance are slim.
Yeah, yeah, that's true. That's true. Would you say the market's about even, or would you say it's more on the seller side? What do you think? It's starting to seem like, Pascagoula, I mean, those numbers are right in my head, but usually I think we have like 71 or 72 on the market right now. And used to, before COVID, we kept about 120, 130,
Yeah,
almost double
yeah, I
that. And
think
that's the
inventory
same
is
with
low.
Gaucher, Ocean Springs, all of them. It still seems like, in my head, we have a low inventory.
We do have a low inventory, and that goes back to the reason we have that low inventory is because people are holding these houses that have those low interest rates. That's
Yeah,
our inventory that we're missing.
yeah, that's true. That's true.
So,
Yeah, 'cause we definitely, like I said, always looking for houses to especially with first time buyers, and I love
mhm.
the energy they have and just the excitement, when you're like, "Yeah,
It's
that's my new home," and they can go in, like I tell them, "You can paint it, you can do whatever you want. It's yours,"
uh
and if you don't paint it and you don't like it, guess what? Do it
paint it
again.
again.
It's still yours. You're paying for it. Paint it whatever you want. Make your house for you while you here is
Mhm.
kinda how I look at it, and I get what you want because this may be the only house you ever buy,
It might
and
be.
that's a lot of people,
It is.
I'm telling you, let's start wrapping it up. Any advice you would give to a first-time buyer? Just definitely keep pushing as money much as you can in savings and checking to be held in the bank.
I wanna this will address a first-time home buyer, but I wanna address young people starting out. Like, all right, so here's what I see. and
Do I
talking
qualify as
to
young?
huh?
Hell, nothing. I was trying to qualify as a young.
You
Never
qualify
mind.
as young. So here's what I'm seeing when I talk and when I say young, I'm talking, people buying their first home, people just getting out of high school, people getting out of college, people just starting out in life, right?
Mhm.
And that age is, different for everyone, but people
That's
that are
right.
saying, "Hey, I'm starting life," starting to do the adult stuff, right? And they don't understand money, credit, or debt, right? There's good credit, there's bad credit, there's good debt, there's bad debt, and there's a way to handle money. And money is a tool, not the goal. And people don't seem to understand that. They're not taught this. So let's give some examples of good credit, bad credit, right? Good credit, a mortgage. Bad credit, a belt card. Belt card has 20% interest rate, and you bought a throwaway item, right? A shirt.
Mhm.
You're going to wear it a few times, it's going to end up in the trash, right? And you bought that for the value of that item plus an exorbitant interest rate, okay, on a credit card.
Okay.
Whereas if you're buying a mortgage, you are buying as an item that appreciates in value. So it's going to be worth more than you paid for it,
Okay.
and it's a lower interest rate, right? So your value is going to exceed the cost that you paid for it over time. That'll never happen on a shirt from Belk. That'll
No.
never happen on a
Mhm.
vehicle from anywhere, right?
No.
So that's the difference. That's the simplified difference between good credit and bad credit. All right. So good debt and bad debt is exactly the same thing. A good debt is going to make you money. Yes, I had to go in debt to buy this, but now I have an income or I have a value that's being appreciated out of that debt. So the mortgage on my home is going up. The value of that home is going up. So it's appreciating. So that's a good debt, right? But if I buy
Okay.
a car and the value of the car is going down, that's a bad debt. Let's say I buy a rental home, right? Well, now that rental home is a good debt because it's bringing me in money. So
Okay.
let's say I bought a bulldozer. Well, that bulldozer goes out and works a job and makes money and pays for itself and puts money in my pocket. That's a good debt. Do you see the difference in good debts
Oh,
and bad
yeah.
debts, right? And that's what a lot of people don't understand. And what happens is young people cover themselves up in bad debt. And there's no way for it to be relieved without them manually doing it. Whereas if they cover themselves up in good debt, the good debt will pay for itself and get it gone.
Right. Yeah.
So as I'm working with younger people starting out, I spend a lot of time educating them on that. So moving in the
That's right.
future, I want them to be successful people, right? Well, let's be honest, successful people are going to come back and see you, right? And if you're
Yeah.
the one that teaches them how to be successful and how to manage good debt and bad debt and always make the profits, they're always going to come back. And that's a loyal customer. You know what I mean? So what I've found is
And
if you treat people really good and take care of them, they're going to
mhm.
take care of you.
And it's I mean, we do a lot of education. We
Mhm.
really do. I mean, for buyers and all, and they need to know stuff, and it's always good to, ask their questions if they, one just went under contract, and I tell them, "Look, your head's gonna be going crazy with all these what if." So
Right.
write them down, and then y'all call me tomorrow because all this is gonna hit you in the middle of the night. So just write them down, and let's talk about it tomorrow, and just make sure that this is gonna be the right fit for you. If you're already stressing over and you want to rearrange the house already, maybe this ain't your house.
Right.
Maybe we need to keep looking until you find that when you walk in. And with most buyers, just like as soon as you walk in, shazam, this is it.
Isn't that
You
cool
know,
when that happens?
this my house. I
You can
took
feel it.
like I said, what I started. I was helping one of our agents, Mary Goodman. She does a lot of the HUD and Fannie Mae and all those repos. So she taught me how to handle the paperwork with those, and I loved them. I mean, I loved doing because we were getting people in houses that could get a house that was affordable. It's bad because sellers are losing houses, but you're helping people buy houses. And I love, I'd always, I would get their list of 5 or 6 properties and I would always look. And we go look at their 5 or 6 properties and I'd say, all right, I got one more house. So we go look at that house and they're like, I don't think we can afford this. And I was like, I think you can, because it's been on the market for 3 months. Let's
Mhm.
run the numbers. So you're getting a newer house, you're paying $15 more a month than you would on a older house. So it's kind of worth the $15 when you look at it,
Here's what
you
I would
know.
want you to do in that situation is as soon as they say, I don't think I can afford it, you go, you know what? Let's make a phone call. Call
Yeah.
me. I will say, This is what your monthly payment will be.
You
Then
see,
you can
that's
decide if you can
perfect.
afford it.
Right, right.
Let me say this, and I really hope this reaches everybody is let's all stop guessing. All right.
Yeah.
So when it comes time to make these decisions, call the professionals, right? Call the realtors,
Mhm.
call the lenders, call the insurance company, get real numbers to make real decisions off of, not assumptions. And I see so many people go, well, it's going to cost you this or it's going to let's call. And it's not that, right? The numbers are different. And what people say, "Well, I can't afford it." Well, that's just an assumption. And then we run the numbers and you go, "Wait a minute, I can afford this." How many people walked
Mhm.
away from something they could have afforded?
Yeah,
So make the phone
and
call, ask
missing
the
out,
question.
especially
The
with
worst that's
this
gonna happen is
market.
they're gonna say, "No, you can't afford it." And then you're gonna be like, "That's what I thought." Okay, no harm, no foul. But what if you can?
But because
Mhm.
if that's the case, okay, we're looking at a house south of I-10. Let's go a little ways north of I-10. You might could get the same house and the insurance is cheaper, so
There
it
you
kind
go.
of pushes you into it
That's right.
because you're saving on the insurance. So you have to, I mean, that's a big thing to look at with their monthly notes. To me, your
And kudos
insurance
to
and
North
taxes,
I-10. Their fire rating just got dropped from a 7 to a 6, which means their insurance is going down, which
even
makes that
better.
even a more affordable area now.
A lot of that can be, not all of it, but we can check for the USDA like we were
That's
talking
right.
about earlier.
Right. So there's a lot of
Well,
good things out
Jeremy,
there that we can get you into a
I
home.
do appreciate you coming on. I think we've got a lot of information, a lot of things to do. And I hope a lot of people can understand, don't be nervous to call and ask a question.
No,
I'm
please call.
approachable. You're very approachable. It's not the stuffed shirt type situation anymore. I want people to be relaxed and comfortable. I try to handle the stress for them before it
Mhm.
gets to them. Why take all this stress when this is your job? You deal with it. Then if you can't deal with it, boom. Then I gotta, because a lot of the simple little things can be dealt with that it's not that, it was one little thing, you know,
Right. So
it
another little
turned
quick
into a
plug
big
on for
thing
me.
and we could handle it.
I'm gonna give myself a little selfless plug. I'm available 7 days a week. So the phone number, shoot me a text if you need to get
Mhm.
pre-approved. The way that process works is shoot me a text, say, "Hey, I need to get pre-approved." I'm gonna text you right back the application. You can fill out the application, and within a few hours, I should say, "Yeah, you're good to go," or "No, you're not." On the weekends, and then Monday morning when I get in there, I'll get you everything you need. But I can get it a letter and everything over the weekend for you.
I love that. Yeah, because that's
So
good. Because that's usually,
that's the holdup.
when we're doing a lot of showings over the weekends, and it's nice. And some people, like I said, I try to make sure everybody's pre-approved. We're already in that process before we step foot in the house.
Right. But
And
sometimes it doesn't work.
that's a big thing too, because it's like, okay, I walk in this house, it's absolutely stunning, but it's 50,000 over what I can afford. So now
Right.
every house I look at, I want that house I can't afford.
That's
And so that makes it hard as a buyer and the agent to reproduce this house that they in love with for $50,000 less.
that's right.
So it's kind of, so I think it's good to know your numbers when we going in.
I think it is so smart. The first thing you do is talk to the lender. Know
Yep.
your budget. Know what you're looking at. Because even if you're approved for $300,000, you may not want to have a $300,000 a month note
No,
because
no, that, and
you want to
that's
right. You don't want to be house poor. So
no, you
you
want that
need to know
monthly
what you're
note.
looking at.
That's a big thing.
Yeah, you need to know exactly what you're looking at. So the other thing you want to think about, and what I feel is a responsible buyer, is if you look at what insurance has done over the last years, it has creeped up every year, right? So
Mhm,
when you're buying your home, don't buy to the absolute max because your insurance is going to increase. And now
mhm.
you're
Oh,
going to
yeah,
be stuck in a payment that's either going to put you in a financial bind or make you lose
which
your
we
home.
don't like to see. I don't
Right.
like to
I
s
don't
Yeah,
want
I know
right.
you don't, and I don't either.
I don't
I'll
either.
tell you anything you want, but Imma give you my opinion, and if I think it's I'm gonna
That's
tell you
right.
what I think. At the end of the day, you're the one paying the note, but I'm gonna tell you what I feel, even though I know a lot of times I just need to shut up and open the door.
Well,
But
I'm the same way.
this don't stop, and I mean, the market's changing and we're going to be doing a lot more, I feel like FaceTiming for people that can't be here to look at a house. Yeah. And
Right.
I'm pretty straightforward with them. If I see some or if it smells like cigarette or pet, I'm gonna tell you as soon as I
Mhm.
walk in. I don't want you get you under contract with a house you ain't seen and then you see it 3 months down the road and you're like, it smells like dog.
Right.
Well, Yeah, it did when I walked in there. I didn't tell you. So always,
For sure. For sure.
interesting.
But yeah, Patrick, I so appreciate you having me on the phone on the
I,
podcast
I'm,
here.
I'm telling you, and I think we went a lot longer over them, but it's fine.
It is.
And I tell you, Jeremy, it was great. I love how this year's going so far. Yeah, I think 2026 is going to be a strange, good year.
I think you're
Yeah.
right. I'm seeing it.
Yeah.
I'm seeing a lot of things moving the right direction. I think we're going to have a lot of fun this year.
I agree. I agree. And like I said, I will put all your contact information linked below so anybody can get out and reach to you. And y'all, if y'all have any questions, shoot us an email or put in comments down below and we will address them.
Yep.
Y'all, this is Patrick Merrill with Lift It. Jeremy Brown, thank you so much for coming on with me. And I hope everybody has a great, blessed weekend. Thank y'all again for taking the time to come along my venture with me. I am Patrick Merrill, and I hope you have been lifted. If not, let me know. We'll figure out a way. There's always a way. Thank y'all again for watching. Please like, share, and subscribe, and tell your friends. Y'all have a great day.